So good afternoon again.
Start with 16-1, huh?
Okay, sir. Okay po.
Sige, I'm sorry.
By the way, guys, I'm James Perfecto together with together with our group mates. We are the group 2 with Miss Therese Consul, Miss Christine Cruz, Miss Gemaline Lavaria, Miss McLean Laksamana, James Perfecto, and our leader, Miss Eunice Takas. So now let's proceed to case 16-1, which is entitled Hospital Supply Incorporated. So now Hospital Supply Incorporated produced hydraulic hoists that were used by hospitals to move bedridden patients. The cost of manufacturing and marketing hydraulic hoists at the company's normal volume of 3,000 units per month are shown in Exhibit 1. So this is our Exhibit 1 table. We have here the unit manufacturing cost, which consists of variable materials, variable labor, variable overhead, and fixed overhead, and its total, which is equals to $2,455. So we also have here the unit marketing cost, which are the variable and fixed cost. The total unit marketing cost and its total unit cost, which is the total of manufacturing and marketing cost, which is equivalent to $3,500 po. So instructions. The following questions refer only to the data given in Exhibit 1. Unless otherwise stated, assume there is no connection between the situations described in the questions. Treat each independently. Unless otherwise stated, assume a regular selling price of $4,350 per unit. So this is going to be our selling price. Ignore the income taxes and other costs not mentioned in Exhibit 1 or in a question itself. So question number 1. What is the break-even volume in units and in sales dollars? So as I've said kanina, ang given natin is yung normal volume is equals to 3,000 units and unit or selling price is equals to $4,350. So this is our Exhibit 1 table. First thing na kukunin natin is yung break-even volume. So this is going to be our formula, TFC, over contribution margin per unit. So first thing na kukunin natin is kunin natin TFC, which is equals to fixed cost per unit times normal volume. So ang ating fixed cost per unit are yung 660, which is fixed overhead over here. Tsaka yung $770, yung nasa baba, marketing cost. Times 3,000, it's equals to $4,290,000. So that's going to be our numerator or our TFC. So next na kukunin natin is yung contribution margin per unit, which is equals to unit price minus unit variable cost. So ito siya, 4,350 minus $2,070 is equals to $2,280. So when we compute it, we're gonna get 1,882 units. That's gonna be our break-even volume in units. So next na kukunin natin is yung break-even in sales dollars. So simply multiply the break-even volume times the unit price. So 1,882 units times our selling price, $4,350 is equals to $8,186,700. So that's going to be our break-even sales. Nakuha po ba? Are you with me here po, ma'am, sir? Yes.
Yes, sir.
So now let's proceed to question number 2. Market research estimates that monthly volume could increase to 3,500 units, which is well within hoist production capacity limitations if the price were cut from $4,350 to $3,850 per unit. So sabi dito, mag-a-add lang sila ng additional 500 units kapag magbababa sila ng presyo. So now, assuming the cost behavior patterns implied by the data in Exhibit 1 are correct, would you or would we recommend that this action to be taken? What would be the impact on monthly sales, cost, and income? So we made a table for this consisting of before the price reduction and after price reduction. So yung price natin sa before price reduction is yung original, which is 4,350. And yung quantity is 3,000 pa rin. Yung sa after price reduction natin, price is 3,850 and with the additional quantity of 500, magiging 3,500 na yung quantity. So what would be the impact on monthly sales? So ang sales natin kapag minultiply natin yung price times quantity is equivalent to $30,050,000. So doon naman sa bago, after price reduction, price times quantity is $13,475,000. That's gonna be our sales, total sales or revenue. So as we can see sa result, mas tumaas yung sales natin. That's the impact on sales. So sa cost naman, our materials are 550 per material. Then labor, ito yung price niya. Overhead, 420 and our variable marketing cost is 275. So simply multiply it to the quantity. So 550 times 3,000, we're gonna get this. Labor, 825 times 3,000, gonna get this, and so on and so forth. So same here sa after price reduction. So yung materials, 550 times 3,500 naman. We're gonna get this one, and so on and so forth. So pag inad natin to, makukuha natin is 6,210,000. Sa kabila naman is $7,245,000. So sa cost, mas tumaas yung cost niya. Yun yung impact natin sa monthly cost. Mas tumaas ang cost sa after price reduction, okay? Mas nalugi tayo ng 610,000 kapag dineduct natin yung sales sa cost. Ayun, nalugi tayo ng 610,000. So then i-deduct natin yung fixed cost. Same pa rin, since fixed naman siya, 610,000 pa rin ang talo natin. So, would we recommend that this action to be taken? Of course not, kasi malulugi tayo. So lowering the prices reduces income. Other factors such as the reduction of available capacity and the impact on market share could also affect the decision. Okay po? So let's proceed to question number 3. On March 1, a contract offer is made to Hospital Supply by the federal government to supply 500 units to Veterans Administration hospitals for delivery by March 31. Because of an unusually large number of rush orders from its regular customers, Hospital Supply plans to produce 4,000 units during March, which will use all available capacity. If the government order is accepted, 500 units normally sold to the regular customers would be lost to a competitor. The contract given by the government would reimburse the government share of March production cost, plus pay a fixed fee or profit of $275. There would be no variable marketing costs incurred on government's units. What impact would accepting the government contract have a March income? So we also made a table for this question consisting of without government contract and with government contract. So dito muna tayo sa without government contract, yung regular 4,000. So revenue natin dito is makukuha natin is 17,400,000. So how do we get this? Simply multiply the unit selling price times 4,000. Yan makukuha natin. Then variable manufacturing cost times 4,000 din. Ito makuha natin. Variable marketing cost times 4,000, which is equivalent to $9,120,000 kapag dineduct natin yung revenue sa ating mga variable manufacturing and marketing cost. So deduct din natin yung fixed cost and we're gonna get the income of $4,830,000. So with government contract naman, instead same lang yung computation dito, ang pinagkaiba lang, difference lang ay instead of 4,000 times 4,000, magiging times 3,500 na lang siya kasi mapupunta yung another 500 sa government. Okay? So revenue natin, $15,225,000. How do we get it? Ganon din. Unit price, selling price times 3,500. Same as here sa variable marketing and manufacturing cost times 3,500. So revenue deducted minus variable manufacturing and marketing cost is equivalent to $7,980,000. So in 500 naman na units mapupunta sa government, we're gonna have the revenue of 1,420,000. So ito yung computation para nakuha yung revenue ng government. So 500 units times 1,795, which is our variable manufacturing cost, plus 12.5%. So bakit 12.5%? Kasi yung 500 is 12.5% ng 4,000. So times our fixed cost, which is $1,980,000 plus 275,000, which is yung profit na sinabi dito. Okay, that's gonna be our revenue. And then sa variable manufacturing cost, times 500 lang siya. So we're gonna get $897,500. So pag dineduct natin, we're gonna have $522,500 po. So add natin siya minus the fixed cost. We're gonna get 4,212,500. So deduct natin yung income ng without government and with government contract. May difference tayo na $617,500. So what impact would accepting the government contract have on March income? Talo tayo ng $617,500. Okay? So the recommendation is do not accept. Next is for mysteries, number 4.
Okay, for number 4 problem, hospital supply has an opportunity to enter foreign market in which price competition is keen. Okay. In an attraction of foreign market is that demand there is a greatest when demand in domestic market is quite low. Thus, ideal production facilities could be used without affecting domestic business. An order of 1,000 units is being sought at a below normal price. In order to enter this market, shipping cost for this order will amount $410 per unit. So, while total cost of obtaining the contract, marketing cost, will be $22,000, domestic business would be unaffected by this order. What is the minimum unit price hospital supply should consider for this order of 1,000 units? So, the minimum price to be considered. So, variable cost. Sir, pa next na po. Okay. Hello, sir. Ayan. Okay. Minimum unit price hospital supplies should consider is the variable cost. Materials is $550, labor $825, overhead $420, shipping costs $410, ordering cost is we get the 22 by dividing the $22,000 to 1,000 units. So we get 22 and the unit revenue is $2,227. So at this price, there will be no profits. There are definitely advantage in selling in foreign markets, such as a new opportunity that could increase. Say, however, we also want to consider fluctuation in currency should be closely watched, as well as the shipping costs that could change from time to time. So our answer is the price that the minimum price is 2,227. So next, number 5. Number 5 question, an inventory of 200 units of an obsolete model of the hoist remain in the stock room. There must be sold through regular channels at reduced price of or inventory sold will be valueless. What is the minimum price that would be acceptable in selling these units? So these are inputs. So other than variable costs, cost-related manufacture for these 200s are already consumed. So it should be 200. How do we arrive at 275? Because that is the marketing cost for a hoist. So we just want to at least any selling price that above the differential cost, that would be also automatically considered as an income because 200 units have to be sold through a regular channel at reduced price. So this price is corresponds to a break-even price for those 200. So we just want to cover the marketing costs and the potential scrap proceeds. So which are an opportunity cost selling of the hoist rather than scrapping them. This assume, however, that the sale of this obsolete hoist will not cut into sales of current model. So next question, number 6 po. So another problem is a proposal is received from an outside contractor who will make 1,000 hydraulic hoist unit per month and ship them directly to hospital supplies customer. As orders are received from hospital supplies, fixed marketing costs would be unaffected, but its variable marketing cost would be cut by 20%. So to $220 per unit. For these 1,000 units produced by contractor, hospital supply plant would operate two-thirds of its normal level and total fixed manufacturing cost would be cut by 30%. So that would be 1,386,000. So what in-house unit cost should be used to compare with the quotation received from the supplier? Should the proposal be accepted for the price of 247 247 sorry 2,475 per unit. So these are we make a table financial analysis for this problem. Next, sir. So this is it consists of all production in-house and 1,000 units contracted. So this will be the revenue. So just almost the same, the variable marketing cost. So as you can see, in all production in-house, will be the variable manufacturing cost would be 5,385,000. For marketing costs, so there's a difference of almost 100,000. So the contribution margin is 6,840,000 and 8,690,000 for the 1,000 units contracted. So the fixed manufacturing cost and the fixed marketing cost remains the same. So we get the 200 we get the 2,444 per unit is the maximum. We arrive at this price simply by lessing the 2,550,000 to 4,994,000. So the answer would be divided to 1,000 units. So we arrive at 2,444 per unit. That would be the acceptable price from the supplier. So number 7. So the last question, assume that the facts are stated in question 6, except that the idle facility would be used to produce 800 modified hydraulic hoists per month for use in the hospital operating rooms. This modified hoist could be sold for $4,950 each, while the variable manufacturing cost would be $3,025 per unit. Variable marketing cost would be $550 per unit. Fixed marketing and manufacturing cost would be unchanged, whether the original 3,000 regular units were manufactured or the mixed 2,000 regular hoist plus the 800 modified hoist was produced. What is the maximum purchase price per unit that hospital supply should be willing to pay outside the contractor? So this time we change the contracted regular units to 800 modified hosts. So as you can see, the revenue for 300 for the regular 3,000 hydraulic hoist is $13,050,000, and we just multiply the regular units, the normal units, to the selling price, which is that 4,000 4,350 compared to the modified, which is this modified hose could be sold by 4,950. So the 4,950 multiplied by 800 modified units, so that yields 3,960,000 for the revenue. So as you can see, the fixed manufacturing cost still the same. So totaling all the income, so we get 2,550,000, and so totaling all the regular and the modified, we get 17, sorry, 8,000. Totaling all the regular out and the modified, we get 17,010,000. And by totaliting that, we get 5,500,000. So we subtract that, we get the price. We get that yields 2,950,000, and we divide that to 1,000 units. We will get the answer of $2,950. So the maximum price that the hospital should be willing to pay outside the contractor is 2,950. The proposal of 2,475 per unit should be accepted since it is below the maximum acceptable payment, which is 2,950. As shown in the analysis, with outsourcing income would be 550,000. Sorry, 5,500,000, which without outsourcing is 2,550,000. Therefore, the maximum payment is 2,950 units per unit. Sorry. So that ends the report for problem 16-1 po.